Hi, I'm Stephanie Link, and I work with Jim Cramer on Action Alerts Plus. And we recently added to another oil name in the fund. We are getting a little bit more bullish on oil. We added Chevron.
Look, Chevron is one of those situations where you begin to get tremendous support because of a 4% yield. This is not a new name for us. Yep. We did a similar. We don't trade in AA+, but when you have rapid gains over a period of a month, we've learned our lesson, and we take them off the table. We had a huge and rapid gain when we bought Chevron in the 60s, and it flew to the 80s. I think the same thing could happen again. Let me state broadly the case for oil, then you state specifically the case for Chevron.
Sure.
I see oil as being the only commodity in the world that is corrected to the point where there are people taking out supply rapidly. You can't take out copper supply quickly, although I know Freeport, a name of ours, is trying.
They're trying.
But it is amazing, and I'm keying on the Transocean call yesterday. Transocean is saying, look, other than deep water projects, there's just a dramatic decline in drilling worldwide. When you get a dramatic decline in drilling and you get a lot of shut-ins like we've seen, then the price stabilizes. Now, one thing we've seen is that when gasoline goes below $2, there is demand. How do we know this? Because gasoline keeps going back to $2. Now, you could say some of that is refineries being put out of action. But I would emphasize that this is a level, and this was very different from 147, where there's actual demand and shrinking supply, and OPEC's playing too. So it's incumbent to overweight oil here, which has not been our strategy to date.
Right. When we have stuck with the large cap, integrated oils, the diversified companies, and I think it's really important, just back to the drillers that you were talking about. Recently at an industry conference, BP said that they are going to really push hard when their contracts come up to the drillers at lower prices. So you're going to see the integrated guys, I think, do better in terms of seeing a little bit better margin going forward. Now, Chevron will certainly benefit, but they also have other good things. They have above average production growth, 4%. X one-time factors, that would be 7%.
And remember, they have big Gulf of Mexico properties coming on next year, which is very significant. Devon has them too, but obviously Devon's too levered to natural gas, which looks like it may not hold $4.
No, but by the way, there has been always speculation about a combination between Chevron and Devon too. So, they have $9 billion in cash. They have their reserve replacement was 148%, X pricing about 80%, still very respectable. And bottom line is the stock's corrected
4 times earnings. Only once in my career have I been betrayed by buying things at that low, which was on Bethlehem Steel, which I was able to cut my losses. And the difference between Bethlehem Steel and Chevron is fully funded pension and has a really fabulous balance sheet. Bethlehem Steel didn't have that. No time in my career for a fully funded pension plan and a good balance sheet have I ever made anything but oodles of money below 5 times earnings. I don't think Chevron will be any different at all this time.
And you get a 4% yield while you wait.
Perfect.
Trade with us in real time. Email us for a free trial, action@thestreet.com.